Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I am going to talk about two different companies. So about a week ago, I decided to do a little bit of research to find out a couple of high growth stocks that I could potentially add to this portfolio or the family portfolio. And while I was doing that, basically I decided to look at two cybersecurity companies. And the reason I did that is because when you think about the trends, like what's going on right now in the world, especially with technology side of things, right? And even in all the wars and everything else, right? One of the industry that is benefiting a lot from that is the cybersecurity, because right now, as everything goes digitally, we need protection. And every single company out there needs to protect their customers. They need to protect their data. Governments now needs to basically do these things. And the US is actually kind of almost forcing the big companies to actually have basically cybersecurity in place. They need to make sure these companies are protecting their data from things like places like North Korea and Russia and so on. So the US actually are spending a lot of money. Companies in the US are spending a lot of money doing this. And I've just reading this an article from McKinsey, and they were saying is about almost the expected, okay, the addressable market for the cybersecurity globally might reach 1.5 trillion to $2 trillion. Correct. But at the moment is not there yet. And when you think about it, from data protection to government risk and compliances, email, cloud security, network security, identity and access management, security, web security, Internet of Things, and every single industry has to be protected. Every single data, every single thing has to be protected. So what we want to do is, because of that, okay, there are obviously AI and so on now starting, and AI will take a massive, because as companies start growing their AI applications and so on, that will then need to be protected too. So the companies that are benefiting a lot from this are two main companies that I want to talk about today. There's others obviously, okay, and the first company I want to talk about is Crowdstrike, and the second company I want to talk about is Palo Alto. Both companies, I've mentioned them before. We've talked about them before. I used to own Crowdstrike a while back. Okay, Palo Alto, I've never owned that company. I've actually had half a share or something in the family, and then I think I sold it a while back. So at the time, I wasn't really too keen on it, basically having high growth in that portfolio, and then I got rid of it. But yeah, so I want to basically go over the two companies. And then I was doing this research for myself. Then I thought, you know what, why not share with the community? Okay, but both companies are great. Palo Alto, you can read it through. I'm not going to go through this, but if you go to their basically earnings presentation recently, you can see it's basically glowing. Everywhere you look at, there is something good about these companies, both of them. Okay, every single angle you look at from these companies, they're doing well. They're growing their business, and basically their top line is growing. Their revenue is growing. They've got market basically share of huge market share when it comes to either software, firewalls, and security and all of that stuff. So both companies are in a very similar situation right now, and they've got, if you go to the presentations, you can see basically where the fact that they actually growing their revenues and everything else is so fast. Okay, you can even see, for example, Crowdstrike. One of the things that I was actually quite impressed was the fact that they expanded their customers base. Okay, basically as of January of 2023, they had 556 of the global 2000 companies using their basic platforms, the Falcons and so on. The 70 out of the 100 the Fortune companies are actually using their platforms. So it is growing. Both of them are growing. So what I want to do now is I want to look at the financials. I want to talk about Crowdstrike first, and then I'm going to talk about Palo Alto. So Crowdstrike is basically they have a software called Falcon, and it's a cloud-based platform that provides a wide range of endpoint security services. So unlike many older cybersecurity companies, Crowdstrike actually does not install any on-site basically appliances. So they don't actually install any software on your computers, on your routers, in your servers and so on, which generally takes up a lot of room, right? So, and just it doesn't require any constant maintenance and can be basically less expensive in comparison to those companies who will actually install those software. Because of that, it's actually is disruptive. That they were the first company to actually do that. Okay, and that's really amazing. Like the fact that you don't necessarily need to install all of these things. They manage it from their side of things, the cloud side of things. They can monitor that data. One of the things that I've done recently was I was watching the CEO talk about basically how they do and what they do and so on. And he was very proud of the fact that they have access to obviously this information, and they can see basically if a company has been targeted, and they can stop basically from their side before even it gets to the company. So it is actually disruptive, and as I said at the beginning, is probably one of the only they were the first company to come up with it. And Palo Alto is slightly different. Okay, it's basically larger, bigger company, if you like. Okay, and it operates with 3 main segments. And there's one called Strata, which basically houses its own site network appliances, which is like the next generation firewall services. They also have one called Prisma, which handles its cloud native services, so everything to do with the cloud side of things. And the third one is Cortex, which is basically a AI powered security tools, which is I watched another the CEO talk about this, and it was actually quite interesting because they had I think it was 3 days ago, they had some sort of a convention where they went to, where they were talking about all the AI stuff, and they were the company of choice when it came to these AI powered security tools. So they both are really in the right industries. But right now, what I want to check is to look at the financials and see out of the two which one I think personally I would add to my portfolio going forward. It is a difficult one because I still haven't made a decision, but in the next few weeks you will definitely see one of these companies in my portfolio. So let's go through the financials, and then we'll take it from there, and I'll let you know where I'm leading towards. Okay, and like I said at the beginning, this is currently basically trading $120 per share. The 5-year, basically the year-to-date performance is about 14% up, so it's actually not down a lot. But there is no 5-year return, obviously, because this company is basically only started in 2019. EPS is obviously negative right now. Okay, so they are still not profitable business, and this is why it's very risky. And you have to be. This is not the type of business that your company or stock, if you like, that you would add to your portfolio without having to do your really basically due diligence. And the reason I say that is because they are losing money already, okay, and they could easily lose money in the next whatever years. So for that reason, it becomes a speculative. But if you know the business, and if you know the business is growing, and you know the stuff that we just talked about, and you have a high conviction, then obviously I would say to you, just do your research, and if you're comfortable, make it this at least 1%, 2%. Overall, maybe no more than 2% of your portfolio. This is not that type of business where you can have, 7-8% of your portfolio. I think that would be very, very risky thing to do, personally anyway. Market cap is only $28 billion right now. Okay, it has a narrow economic mode, which is very, very interesting, because I thought the cloud native side of things will basically have a wide economic mode. I guess there are other companies that are doing the same thing. So that for that reason, I think it is probably the right thing to do. Beta is above just 1. Okay, I think this might not be accurate, I'll be honest with you, because when it comes to beta, let me just double check, because I think they must have a higher beta. Let me double check quickly. It's actually right, yeah. So just above 1, but normally we're looking for anything below 1 anyway. Obviously, we wouldn't have a PE because there's no earnings yet. But the forward PE actually looks all right. 50, I say okay. But for this type of business, it's 51, right? In comparison to the sector, it's actually not that bad. Now, the 5-year does not exist, but price to free cash flow here is about 43, which is absolutely fine. They do have some cash, okay, or basically almost a 700 million, which is fine. Free cash flow margin is about 33, which is really good for this type of business, right? Free cash flow yield is about 2.5. Again, we're looking for about anything above 3% and so on. Profit margin is 8%. Operating margin is 8, but basically minus 8%. So again, this is until the company starts making money and becomes profitable. That's obviously going to be a while, right? Total return in the last only 3 years, we're looking at about 21%, which is absolutely fine. Return on invested capital, again, is not non-existent. But revenue growth, basically in the last 5 years, we're compounding annual growth of 88%, which is absolutely huge. And that's probably why the company has been trading very, very expensively like recently. So current ratio is above 1, so they have enough to pay off their current liabilities. So in the next year, they're expecting the earnings to grow almost about 20%, and then 37% every year after that. That's huge, 37% and every single year. If that's correct and what they're saying is actually the truth, then obviously that will be amazing. And if we look at the earnings basically estimates for the EPS, for example, it's actually more, I think it looks like it's all right, because 38, and the 9 analysts are looking at this. One of them said about 50% basically growth, and then 20, almost to 30% growth. And when it comes to the total revenue, we're looking about growing from $3 billion to $6 billion in this space of about 4 years, okay, which is absolutely huge for this company. So I think there's this element of truth in that. Fairly valued, again, that's the expectation of the analysts. So again, it's the same people, I guess. Like we've already seen, current price is 120. Fairly valued, okay, undervalued according to Simply Wall Street, undervalued according to Morningstar, okay. Again, tip rank is exactly the same, as well as Seeking Alpha. So they've all more or less agreed this company is a buy right now, and they are discounted. So if you were to buy this company right now, basically this company is saying is you will make about 4%, 5%, and then so on, okay. In terms of Sharia compliance side of things, we're looking about 37, again 3% here, and then 10% on that side. Obviously, you expected these companies to basically dilute your shares, because that's how they do things, okay? If they want to reinvest in the business, which I'm absolutely fine with, until the company becomes a mature company, then obviously that's exactly what's going to happen, right? So that's the first company. Now let's have a look at the Palo Alto, okay? Again, we talked about the business side of things. Let's have a look at the financials. Currently trading $182 per share. A year to date is actually up 30%. Is actually gone up quite a bit. When I bought that half a share, is actually gone up like almost to 20% in a space of 5 days or whatever. I couldn't buy more of it, so I just sold it at that point. That was for the family portfolio. But the 5-year growth rate, basically, or 5-year return, we're looking at about 184%, which is absolutely huge. The company is now profitable, so they've got zero, basically a 8 cents, basically this, which is good. It's heading in the right direction, right? Market cap wise is $55 billion, and it has a wide economic moat. Beta is slightly higher, okay. PE obviously will be in the thousands, okay, and then forward PE looks actually fine, 45%, and then 5-year average, the 5-year PE average is like 58, so that's basically below that, so which is looks fine. But when you look at the free cash flow here, price to free cash flow is actually quite nice, so it seems it's actually a little bit undervalued at the moment. Free cash flow of 2.6, almost $2.7 billion, which is really good. Free cash flow margin of 35%. Free cash flow yield of almost basically 5%, which is really good. And then profit margins and all of that is starting to, okay, we just beginning, so there's not much of a return on invested capital yet. And then in the last 5 years, they grew that revenue about 55%, okay. Current ratio is just below 1, so which is because they do have a bit of a cash, I wouldn't worry too much about that. So the next 12 months, I think they should be able to cover that liabilities, whatever that is. So 16% growth expected for this year in terms of earnings, and then 30% every single year for the next 5 years. According to Simply Wall Street, is actually 8% undervalued. According to TipRank, is Morningstar is about 9% discounted right now. According to TipRank, 24%, and according to Seeking Alpha is 21% upside. So everyone again agrees this company is also a buy, and 99% in terms of business side of things, and the Sharia compliance side of things. Interest-bearing debt is about 8%, and then 7% in terms of interest-bearing securities. Obviously, they would have been doing the same thing as Crowdstrike in terms of diluting your shares. Again, sooner or later, once the company becomes a little bit more profitable, they've got a little bit more money lying around, then they will buy back their own shares when it becomes cheap, I guess. Okay. But yeah, so both companies are heading in the right direction. So let me just quickly show you the earnings for expectations for Palo Alto. So let's have a look at, we're looking at annualized, we're looking about almost 60% this year, July of 2023. That's 42 people, 42 again 22. So we just looked at the first 3 here, and then 16% and then 17% after that, which is actually quite good. And when you look at the revenue side of it, 25%, 21%, 19%, 26%. So again, looking at the first three, it looks like it's heading the right direction from almost 7 billion to almost 10 billion in 3 years time. So the companies are really good. They're growing. They're in the right industry. There's so much going on. The US is spending a lot of money on cybersecurity side of things. Companies are protecting their data because obviously what's happening in Russia, what's happening in North Korea, and all the other places as well. So the US government are kind of forcing these companies to protect their data and so on. And the company of choices are these two companies. So what am I going to do moving forward? I don't know yet. Okay, one of these companies will definitely be on in my portfolio, especially, and I'm talking about this portfolio here. So my initial plan was to take out all the non-dividend paying companies, but I think that's a little bit silly. So I'm gonna keep 10% of this overall portfolio. And I think right now, I think this company, let's check what percentage this is. Where's Adobe? Here we go. Adobe, there we go. So Adobe is about 2% right now. So what I'm going to try to do is I'm going to have non-dividend paying companies, about 10% of non-dividend paying companies in this portfolio. And that will be one of them will be either CrowdStrike or Palo Alto. I don't think I want to own both of them because that's very risky. And then I'm going to start looking at other companies that I could basically add to the portfolio that are high growth. That means basically a lot of volatility and so on. But I really genuinely love these companies. And I think in the long run, I think in about 10 years down the line, I will look back and basically say, you know what, I was silly not adding these companies. So the way especially things are going and working in technology, I do know where technology is going, and the fact that it's actually almost taken over our lives right now. So there you have it. There's two companies that I'm interested, and again, do your research if you're really interested. I hope you enjoy this type of content. I will be doing a lot more of this inshallah in the next few weeks and so on. Obviously because of Eid and Ramadan in the last 10 days, I haven't done much, but I will be doing that. I will be answering some of your questions. Apologies about the voice. I think I've corrected it today. If it's still not great, let me know. I think some of you said it wasn't that great, wasn't loud enough, I guess. But yeah, so if you haven't joined us on the Discord, please do so, because it really genuinely helps the channel. Okay, it kind of helps me motivated and go on with it, the things that we do, everything. Like, it takes a lot of time and effort to put these videos together, so I would really appreciate if you can just join us, get some of these access to these things, and at the same time, even if you do for 1 month, at least that you will get a lot of benefit, especially with the Discord. Okay, the Discord, there's a lot of really lovely people there that on daily basis post and talk to each other about things and things they're doing and help each other, and I kind of go in there just to say my piece at times. Okay, so yeah, let me know if you have any questions. Inshallah, have a wonderful day. Assalamu Alaikum.